Hello class, this is our discussion of Chapter 5, Itemized Deductions from your textbook. Just a quick review. Remember, a taxpayer can subtract either the greater of the total itemized deductions or their standard deduction. So it's one or the other, not both. So you pick the one that is the best for the taxpayer. Now, given this 2018's new increased standard deduction, basically the standard deductions all doubled, itemized deductions are going to become less important. There will be a lot more people who will use the standard deduction rather than the itemized because the standard will be higher. That and some of the itemized deductions have been eliminated in 2018. So again, there will be fewer people who benefit from itemized deductions. But those that will, we need to still know the rules. So let's see some of these, how they work. These are our basic categories of itemized deductions. The other miscellaneous deductions are basically non-existent now. There's still a very short chapter about them, but really all they are is now miscellaneous deductions are gambling losses, that and a few expenses for the production of income that were before not subject to 2% floor. So most of them were done away with. These all get reported on Schedule A, as you see there. You have your 6 types, all have their own kind of like section, you might say, on the Schedule A. Medical and dental, notice that these are unreimbursed, meaning that your insurance didn't pay you for them. Notice who it needs to be. You can't just pay medical expenses for anyone. It has to be someone that is either your spouse or an dependent according to the citizenship, support, and relationship tests. Okay? And then they are only deductible if they go over 7.5% of your AGI. So here's the kinds of things that there. Notice transportation expense, driving to or from the doctor, 18 cents a mile. Notice how low the lodging limit is, $50 per person per night. That is the idea that if you needed to take your son or daughter to the hospital and stay there overnight, let's say they went for treatment and it was such that you need to go the night before, stay in a hotel, go in very early in the morning for dialysis or some other type of treatment. You could do it for both people because you were needed to accompany them. Or after surgery, they were not going to be able to drive, and therefore you had to go with them. That's what we're talking about, where it could be more than one person, but it's still only $50. So if you and your child were there, you get a $100 deduction no matter what you actually spend on the hotel. All right. Now, capital expenditures can be medical expenses, except when they increase the value of your house. All right. So if you get something back more than what your expense, it actually is income. If it happens to be reimbursement in the year after you deducted it and you got a benefit from it, it could be income in the current year. Okay. First section is medical expenses. Figure out the total. You subtract the 7.5% of AGI. Taxes. State and local. Notice all property taxes vary, even foreign. Okay. Foreign income taxes, well, we'll talk about that in a minute. The idea with general sales taxes is they can be done either that or the state or local income taxes. Be careful with state and local income taxes. This is where the mistakes get made. You're going to look at the W-2 for the year, any estimated tax payments made during the year, plus you need to look at what you paid during the current year. So for instance, to deduct taxes paid in 2018, it must be paid in 2018. It could be that you're paying taxes that are for a return you filed in 2017, because usually you file your tax return after the year is over. So you file your tax return in 2018, you pay taxes with it that actually belong to 2017. Those taxes are deductible in 2018 because that's when you paid it. All right, so it doesn't matter what year they apply to. So example, here's your withholding, you paid, estimated, and this is what you paid in 2018 when you filed your 2017 return. The amount that you paid with your 2018 return, which of course is filed in 2019, will be deductible in 2019. Real estate taxes are ad valorem tax. Taxes based on the value of the property. Okay? Now, notice when you do it in the year that you paid, be careful of special assessments. Sometimes you'll get assessed on your property like a special tax for street lighting or some other type of improvement. Those are considered improvements to your property and are not deductible as property taxes. Okay? Now there's a little thing there about 2 years in one for tax planning. That's not going to work very well anymore because we have a maximum for all of taxes. We'll see in just a little bit. State and local personal property taxes. This is where you have to be a little careful. Okay? Has to be based on the value of the personal property. Usually this is your automobile, motorhome, things like that. But state of Pennsylvania, for instance, you pay a license fee. Everybody pays the same $36 per year. In the state of Washington, for instance, you pay based on the value of your vehicle. So that's an ad valorem tax. That would be deductible. The license fee of $36 in Pennsylvania, because it's all the same, is not a deductible tax. Okay? So that's where it kind of, there's a fuzzy line there. This is, I've never seen a tax on stocks and bonds, but I'm sure there is in some state somewhere. Foreign income taxes, like we said, can be computed either the tax credit, itemized deduction, but not both. Usually the credit's going to be better. General sales tax, if it's more than income taxes. Okay, so you pick one or the two, whichever was the highest. Usually the state and local income tax is going to be higher in Pennsylvania. New rule for 2018, total taxes deducted cannot be more than $10,000. So it doesn't matter how much you pay of all of these, the maximum that you can deduct is $10,000. That really hurts those who live in very high tax areas. These are non-deductible. So the amount you actually pay for the federal government is not deductible for calculating your federal income tax. Social Security and Medicare is not deductible. All right, and then the fees and excise taxes you pay when you buy gas, buy cigarettes. All right, and if you pay taxes for others, the taxes have to be owed by you for you to be able to deduct it. Tax refunds, we already talked about the fact that if you get a tax benefit in the year before and you get a refund, then you have to include it in income. The second section on the Schedule A is your deductible taxes. Next one is deductible interest. Interest deductible on Schedule A, home mortgage interest, main home plus one second home, up to 2 houses. Okay? And then there's a maximum. All right, the old maximum was $1 million. The new one is $750,000, which means if you borrow more than that, you're not going to be able to deduct all of the interest you paid. And notice it is only for acquisition debt, the amount to buy or improve your home that is actually the collateral for the loan. Okay, so it's much more limited than it was before. Home equity loans only if you use to acquire or fix up the property securing the loan. It used to be you could consolidate credit card debt, things like that. No more. Example of how the different homes work: main home, vacation homes. You have to pick two. You pick the one that the highest interest, right, to get the highest expense. If main home is 0, then you only get to choose one vacation home. The second vacation home is non-deductible as far as mortgage interest. Points. This is prepaid interest. Usually you have to take this interest and spread it out over the life of the loan, but there's exception is if you buy it to improve your main home, the principal residence, you deduct it all in the year, full in the year paid, if that is the way that most loans are done and it's customary and it's not for other services. So that's the extra caveat in the law. It has to be the normal course of business that everybody is buying points. 200,000, pay points 2.5. Established practice, it's not more than is usually charged. Then he can deduct the whole thing in the year he paid that on his mortgage. Another example, again, improvements or purchase of his main home. Investment interest. Now this is limited a little bit more. You can't deduct interest if you take a loan out to buy non-taxable interest investments, tax-exempt investments. So if you take out a loan, borrow $10,000, invest it in municipal bonds, get interest on those municipal bonds, the interest you pay on the loan you took out is not deductible. Okay, well, the interest you get from investments is not includable, so it's kind of even. If you buy investments that are taxable, the amount of investment interest cannot exceed your net investment income. If you exceed it, you can carry this over to future years indefinitely. Now you can do some recharacterization of your dividends and net capital gain in order to increase your investment income. I'll show you an example. Borrow $70,000, purchase taxable bonds, pays $5,000 of interest on this loan. She's sole source of investment income is $4,500 of interest from the bonds. She can deduct $4,500 of investment interest. The rest of the $500 is going to carry over to future years, and she can use it if she has more investment interest in that year. Now, Ken has $5,400. His investment income is $6,500. But look at how it's broken down. Some of it's qualified dividend. Remember, they have special treatment. And $2,500 of taxable interest, which doesn't have special treatment. He has a choice. He can deduct $2,500 and carry over the $2,900, meaning uses out of the $5,400, he uses the $2,500 to offset the $2,500 in taxable interest, and the other $2,900 goes to next year. Or he can count the $2,900 out of his qualified dividends as not special. Don't get special treatment. Don't get the lower tax rate. The rest is taxed at the reduced rate. Then the $5,400 of interest can be deducted against up to the net investment income, because now he has the full $5,400 he needs to deduct this interest. So you got two choices. You give up the special treatment and get more investment income, or don't give up the special treatment and less investment income and carryover in this case. Okay, we'll stop there. Interest, well, let's get interest on the Schedule A right there in the middle. All right, we'll pick up gifts to charity in the next part of our podcast.